Hello, everyone. My name is Beth White, Director of Class Giving at Skidmore, and a proud parent of a class of 2021 alumni. It's my genuine pleasure to introduce our presenter today, Art Tracy, Skidmore's Director of Gift Planning. When I've partnered with donors who want to support the college, they have found Art's expertise valuable, enabling them to have a larger impact by considering various giving vehicles to achieve tax-savvy philanthropy. You'll see an option to send questions confidentially via the Ask a Question button if you're viewing from our Alumni Learning Consortium landing page. We'll do our best to provide answers to as many questions as possible. We ask that you keep your questions general during this session and invite you to contact Art with more specific questions related to your own personal circumstances after this presentation. With that, it's my pleasure to introduce Skidmore's Director of Gift Planning, Art Tracy.
Thank you, Beth, and welcome everybody. It's my pleasure to welcome you and offer you some general information about tax-savvy ways to give to Skidmore and other nonprofits that you care about during today's session. As Beth had mentioned, I'd be pleased to visit with you individually to discuss your own circumstances, and just feel free to contact me. There'll be contact information at the end of the presentation. I've got a fairly succinct conversation or a presentation here to illustrate these concepts that I'm going to walk through briefly, and then we'll have questions, as Beth had mentioned, at the end. So with that, I would like to begin. All right, we're going to talk about achieving your philanthropic goals for Skidmore. And this all begins with you. What is it that you want to do at the college? Before I get going on the main part of the presentation, I did want to mention that Skidmore participates in Giving Tuesday. It's going to be on December 3rd. It's a global day of giving, and you can help share the joy of giving with our students. During finals week, we'll give them a cookie for every donor. So feel free to participate in that, and you can help other students as well. Alrighty, well. So I'm going to cover three things during the presentation today. I'm going to talk to you about how you can make an impact now. I will talk about estate giving, and then I'll talk about something sort of in between, gifts that generate an income for you. Okay, as far as making an impact right now, let's talk about the giving of long-term, highly appreciated securities. So let's talk about the term, first of all. Appreciated securities, we're talking about stocks, bonds, mutual funds, that sort of thing that have gone up in value. The term long-term essentially means that you've owned it more than 12 months. And usually if they're highly appreciated, they will you have owned them for more than 12 months. So that's usually not an issue. But why is it good to give long-term, highly appreciated securities instead of cash? And I'll give you an example in just a minute. These gifts actually cost less than giving cash. And why is that? Well, you pay less for that particular stock. It's gone up in value, of course, in time, but the same cash gift is more expensive than what you paid for that stock or mutual fund. So that's the first thing. It's actually more cost effective. You do get, for the people that itemize, you get a charitable deduction for the full fair market value of the security, which will further reduce the cost of your gift. You will eliminate capital gain from your portfolio. And you say, well, I really like that Amazon stock, or you name the stock. I like it. I don't want to get rid of it. Well, what you can do is that instead of giving cash, you go ahead and give that stock to the college, and then you use the cash that you would have used to make your gift and just repurchase that particular stock mutual fund. And what the value in doing that is that now you have eliminated that capital gain in your portfolio, because you're essentially buying it for your basis is higher. It's, you pay more for it. So there's a lot of good advantages to giving this way. Let's take a look at a specific example. All right. Here is a $2,500 cash gift versus a $2,500 stock gift. And the cash gift, the cost of that gift is $2,500. You would save taxes of $800, and that's based on a person in the 32% income tax bracket. So 32% of $2,500 is $800. So the net cost of giving that cash is $1,700. All right, let's take a look at stock. Let's say you bought this stock quite a few years ago, and although it's currently worth $2,500, you paid $1,000 for it. So you can see there's a $1,500 gain. But you get the same income tax deduction if you're itemizing. And so this person is in a 32% bracket again for the comparison. And so it's the same $800 savings. So the net cost of that gift is $800. But there's some other advantages, which I mentioned. You eliminate the $1,500 capital gain from your portfolio, and then you will actually avoid a capital gain tax. That the gain there, it would be $1,500 times the 15% capital gain tax rate. So you avoid a $225 tax if you were to sell that stock yourself. You give it to the college, we sell it, there's no tax involved. We're a nonprofit organization, so we don't have to pay that tax. And then, like I said before, you take your $2,500 that you were going to give and you repurchase that stock. So you've eliminated that gain in your portfolio, which is always good because that means less tax in the long run. So it's a very efficient way to give. Let's take a look at the next example. To make an impact now. This is for people that own individual retirement accounts. You can donate from an individual retirement account to the college or any qualified charity in what is known as a qualified charitable distribution, or QCD. The gift has to be done. You cannot take your distribution from your IRA, have a check paid to you from your IRA, and then put it in your account, and then give us that amount. The check or the cash, actually, the gift has to come directly from your IRA to Skidmore. Some people own IRA checkbooks. I was just talking to a donor yesterday, and just wanted to make clear, because he said, "Oh, I'll write you a check," and he says, "Yes, it's a check from his IRA, is a checkbook." So a lot of people have that. If you don't, you just call up your IRA administrator and they can make a check payable to Skidmore College from your IRA. So it has to be transferred directly from your IRA to Skidmore. If you don't do that, it is going to be taxable income to you, and that defeats the whole purpose of a qualified charitable distribution. So that's very key to it. You have to be at least 70 and a half years old to do a qualified charitable distribution. And one of the key benefits of this is that it does not increase your taxable income. So you take the money, you give it to Skidmore through a QCD, you get credit. That's the next bullet. You get credit for an RMD if you're 73 and older, because you have to be 73 to have a required minimum distribution. And if you're in that category where you're 73 and older, you get credit towards your RMD, but it does not increase your taxable income. So very big benefits right there. And one thing I'm going to go through in an example here is that it might possibly help you to lower your Medicare Part B premium. Well, how is that? Well, Medicare Part B premiums are based on your income. And if you take the distribution from your IRA, your income goes up. So if you do a qualified charitable distribution, well, although the money comes out of your IRA, your income does not go up. And so that potentially could move you into a lower income bracket where it could reduce the cost of your Medicare Part B premiums. I'll go through an example in just a minute. So there's a max limit right now of giving this way, a qualified charitable distribution of $105,000 per IRA per year. That's the 2024 amount. This started out a number of years ago at 100,000. It's been indexed for inflation, and we'll probably, I don't have the numbers for 2025, but I suspect that it's probably the max has increased a little bit. It'll increase next year. So let's take a look at an example. of this. And here you can see, I wanted to show you the Medicare Part B premium chart here. And you can see that it's all based on your income. The left-hand column is a single filer, the middle column is a joint filer, and then you can see in the right column the monthly premiums. So a single filer with under $103,000 or up to $103,000 of income, their premium would be $174.70. In the example that I'm going to show you right now, it's a single filer, and the income is, I think, 130,000 or a little bit more. So it's in this third line here, 129,000 to 161,000, and the premium is $349.40 per month. So we're going to do an example right now for somebody who's a single filer in that income bracket. All right, so Joan, this is the example. Joan is age 75, and she makes $5,000 cash gifts to Skidmore every December. That's cash gifts. So what does this look like if she does a qualified charitable distribution from her IRA? Well, you can read the second bullet there. She'll save $104.80 per month on her Medicare Part premium, Medicare Part B premiums, or almost $1,300, well, $1,257 on her Medicare premiums for the year. So you can see in the left column the source of income. She has Social Security income. She has a 401k where she has an RMD of 46,000. She has an IRA where there's an RMD of 46,000, and then taxable income. So right now, the middle column here, where she makes a $5,000 cash gift, her Social Security income would be 40,000. Her RMD, she takes that. She has to 46,000. Her RMD from her IRA, another 46,000. So the total taxable income for Joan is 132,000. And you'll recall in the previous chart, she was at the higher amount for her Medicare premium, $349.40. So instead of giving cash, she arranges for a gift, a transfer directly out of her IRA to Skidmore. Her Social Security stays the same, 40,000. Her RMD for her 401k, the money's actually coming out of her IRA. So her 401k, she still takes the $46,000 out. So that's the same. But out of her IRA, she takes that $5,000 and gives it to Skidmore. So you can see that instead of $46,000 of income, taxable income from her IRA, it's now down to 41. She gets credit, that 5,000 she gets credit for the 5,000 towards her RMD, but it does not increase her taxable income. That's the beauty there. So you add up her income, and she's reduced it by $5,000 to $127,000. And the premium, since she's gone below that threshold, is now $244.60. So it's almost $1,257 per year. It's a nice savings. She makes the same gift, and she's paying less for her Medicare Part B. It doesn't work for everybody. You have to take a look at your own individual circumstances. But if it works for you, you're going to like it. And I'd be happy to, explore this with you if you have questions on it and further questions. Very nice way to give. Make an impact now. What are other ways that you can make an impact now? We have several of them. I'm not going to get into great detail. I'll just sort of go over them briefly. But real estate is a great way to give. And you think, well, I can't give my house away. I'll actually go through an example where you can actually get tax benefit, but continue to live in your home. This applies to people that maybe are going to leave a significant bequest or an estate gift to the college, but I'll get into that in a minute. But there's other ways to give real estate, and you can give what's called an undivided partial interest in your real estate. You can use real estate, which I'll actually talk about in a minute, to fund gifts that pay you income. We will take properties. We've accepted vacant land that was not needed by an owner here, actually locally here. So there's a number of different options for real estate. There's a thing that's called a bargain sale gift where you have a property that maybe you have a mortgage on, and you can't just give it entirely to the college, but we can purchase it from you for a reduced price below the market value, and you can take what we give you, and you can pay off the mortgage. And there's a charitable gift there. So there's just a lot of ways to give real estate. We accept artwork. The Tang Museum, we have a large collection, and we're constantly accepting artwork. There is an approval process because it has to be, we have to be able to use your artwork in our educational mission. So there's a process involved there. We do have gifts of horses, and there's also a process as well. And lastly, the thing I want to mention is that any insurance policy that has a cash value, we can take those as well. So if there's any questions on any of those, contact me individually. I can go into great detail on any of those. So let's shift over. We've talked about making an impact now. Let's talk about estate gifts. There's a few things that you need to keep in mind about legacy gifts or estate gifts. We are legally obligated to use your gift as you direct. So if you say it's to be for scholarships, that's what we're going to use it for. We can't take it and use it for paying the lights or put it towards a building or what have you. We are legally obligated to use it for your designated purpose. Well, why is that significant? Well, sometimes people have restrictions on gifts that we actually can't find. We're not able to use that, or it might be actually illegal. So if you have a designation for your estate gift and there's any question in your mind, please check with us. You can contact me directly. We just want to make sure that we're able to be a good steward of your legacy and that we're able to carry it out. So it's very important that you share that purpose with us so that you can rest assured that it's something that we can do. So please share that. If you don't designate your estate gift, and we do receive plenty of them, we have a policy for how those gifts are used. Anything under $150,000, it goes towards current operations, much of which goes towards supporting students' scholarships. We do a terrific job supporting our students, and a lot of that money actually supports student scholarships. So it's under $150,000, that's where it goes. If it's over $150,000 or greater, then the college will decide how to use it. Typically, and the president and a number of board members will get together periodically, and they will decide how that money is to be used. Much of it goes into the endowment for the permanent operation of the college. Sometimes when we have capital construction, like we have a number of projects right now, that money is applied towards those projects. And that's typically where those larger undesignated estate gifts go. So just keep those things in mind. And the first way to give through your estate is through either a will or a living trust. A living trust is essentially like a will. It just avoids the probate process. So you can give either a percent of your estate or a dollar amount. We do have suggested language that you can share with your attorney. It's on our website. If you can't find it, just contact me. We're always happy to provide that. And it could be undesignated, or if you have a designation, we can give you language that would be appropriate for your designation. So that's the most common way. And then a very easy way that of course involves an attorney, but there's also several ways that you can give through your estate that does not involve an attorney. And those are beneficiary designations. Retirement accounts all have designated beneficiaries. You can have a primary, typically it might be a spouse or children, but there's secondary beneficiaries, and that could be Skidmore College. There is definitely a tax advantage to giving this way, because retirement accounts and commercial annuities, the second item there, are both taxable in your estate, where if you gave those to the college and gave other assets to your heirs, they're not going to be reduced by taxes. Since we're a nonprofit organization. So those are really smart ways to give if you have a choice to what to give your heirs, and you want to make a gift through your estate to the college. Those are really prime assets to give, a retirement account or a commercial annuity. Donor advised funds, we have a number of people. Fidelity, for example, has their donor advised fund, and there's a lot of places that do, but that's for current lifetime giving. But at the end of your lifetime, if there's a balance left in your donor advised fund, you can actually designate that to come to the college. You would just work with your administrator of the donor advised fund, and they can arrange for that. Life insurance policies as well. You can make the college a beneficiary of your life insurance policy. You can actually make the college a current owner and beneficiary. And if you do make the college a current owner and beneficiary, we're not going to pay the premiums, but you can pay the premium, and you get an income tax deduction for paying the premium. So the number of ways to give life insurance, but the primary two ways to give through your estate are either through your will or your living trust and beneficiary designations. So I had mentioned earlier an estate gift that you can actually save taxes now. And how is that? Because the estate gift flows, at the end of your lifetime. It's called a retained life estate, and this involves the use of your home or a vacation home. And essentially what happens is that you donate, the IRS considers your property, your home, to have two components. One is the life use component, and then the second part of it is the remainder interest. If you donate the remainder interest in your home to Skidmore now, you can continue living there, and that's the big advantage of it. But you get a nice income tax, a very significant income tax deduction. And here's an example of what that might look like for a couple age 77 and 79. They donate the remainder interest in their $500,000 vacation house to Skidmore. It's a deed, and there's an approval process that we have to go through, but it's mainly a formality. But so they deed over the remainder interest of their vacation home to the college, and they get a very significant income tax deduction. In this particular case, they're in the 32% income tax bracket. They will actually save $75,000, more than $75,000 on income taxes. And if need be, they can take their deduction. I don't show the deduction, but the deduction actually saves them $75,000. If the deduction is too large to be taken in 1 year, and oftentimes it will be, you have a total of 6 years to use the deduction. So a very significant income tax savings on that. They can continue to use the vacation home as they always have. You'll continue to be responsible for all the expenses associated with it, tax, maintenance, insurance, etc. But the final benefit actually of this is that the property is actually removed from their estate, so their executor will not have to deal with it. So it actually saves time and expense, and of course it puts more money in the donor's pocket. So that's the way that somebody could save on an estate gift, save taxes on it. This is obviously for somebody who's going to make a significant gift to the college through their will or their estate. And but it's a way, really, if you're serious and you have other assets to take care of healthcare and that sort of thing, that you can really benefit from this. Okay. Let's talk about the third area, income generating gifts and how they work. You donate cash, appreciated securities, or real estate to the college. You get a partial income tax deduction. Why is it partial? Why is it not the full value? Well, it's partial because we're going to be paying income back to you. So your gift is not the full value of what you give, but a percentage of it, a portion of it. So you earn a partial income tax deduction, very significant, however. And for planning purposes, you can think half the value, but it all depends on how much money we are going to pay you and your age. And so we can, if you're interested in this, as I said, contact me directly and we can take a look at exactly what it might look like for you. But you donate the asset, you get the partial income tax deduction, and then we pay you for life. And those are reliable. That's a very reliable source of income. If you do an option which is called a charitable gift annuity, I'll go through again in just a minute. I'll go through that. Your payments are it's guaranteed by Skidmore's endowment and our assets. It's very reliable. And then the remainder after your lifetime goes to your designated charitable purpose. So we have two different payment options. The college offers a fixed payment option, which is called a charitable gift annuity. That's fixed payment, doesn't vary. And then the variable payment option, which is called a charitable remainder unit trust. So what do these look like? For the fixed payment option, the charitable gift annuity, the payments you can opt to start now, or you can defer to start receiving them at some point in the future, maybe when you reach a certain age or when you retire. So there's that option. And you can have one or two income beneficiaries, and the rate is based on age. The older the beneficiaries are, the higher the rate. The younger, the lower the rate. We do have a minimum age of 60, and most charities actually do have a minimum age of 60, although not all of them. There's a significant amount of tax-free income that is possible out of a charitable gift annuity. I'll show you that in just a minute. And as I mentioned a minute ago, payments are guaranteed by Skidmore's endowment. We have quite a few gift annuitants that give this way. Why the age of minimum of 60? Most charities follow rates set by the American Council on Gift Annuities, and Skidmore does. I'd say probably 95% of the charities follow that. There's a few that don't. Most charities, I would say, probably have an older 60 or older, or somewhere in that neighborhood. They generally don't pay them to children. I guess the rates are set for children, but frankly, that is such a long time for the college to hold it, and we don't want it to become. It's supposed to be a charitable gift, and the potential exists. The lower the age, there's a much greater potential that the gift does not actually turn into a gift, but a liability, because we are obligated to continue paying, even maybe if we've exhausted all the money that you gave us. We will invest it, but as you know, the markets go up and down, and sometimes gifts actually turn into liabilities, and so that's generally why most charities do not pay younger beneficiaries for that. So our age minimum is 60, and we have a gift minimum of $10,000. That's the fixed payment option. So what does it look like if you have $100,000 cash funded one life charitable gift annuity? And when I say one life, the payments are guaranteed for the life of the individual that receives them. You can have a 2-life agreement, and the way that works is that payments will continue as long as one of those two people is alive. So you can see at age 60, the annual payment for this $100,000 gift is $5,200. That's a 5.2% rate. And you can look down there at age 80 for the same gift of $100,000 cash, and it's $8,100. So it goes up to 8.1%. You can see how the older you are, the bigger your annual payment. There is tax-free return of principal to you. And so at age 60, of your $5,200 payment that you receive each year, and that's generally we pay quarterly, but anyway, that $5,200 annual payment amount that you receive, $2,683 of is tax-free return of principal. So you won't have to pay tax on that part. Your $100,000 cash gift will earn you at age 60, will earn you a charitable income tax deduction of $35,365. That's based on somebody being at a 32% income tax bracket. If you're at 24%, it's going to be lower, obviously. And then there's the associated taxes that you save. For that $35,365 for that donor, that particular person is in the 32% tax bracket, as I just mentioned, and their tax savings would be $11,317. So really, that $100,000 gift doesn't cost you $100,000; it costs you 89, actually 88 and change. And as I say, the older that you get, the bigger the tax savings would be, the bigger the payment and so forth. So those are just some sample rates. We can get you the rates. We can get you 2 life rates. We can look at what this looks like for you. I did want to mention that charitable gift annuity can be funded with a QCD. We talked about those at the beginning of the presentation. A QCD is a qualified charitable distribution. It's IRA funded. It's an IRA funded charitable gift annuity. So you have a $53,000 lifetime maximum. The government allows you to use $53,000 from your IRA to fund a charitable gift annuity, and no more. It's going to be indexed for inflation, so it's probably going to go up next year. It started out a couple of years ago at 50. It's at 53. It's probably going to it's going to continue to go up. I'm sure it'll be a little bit higher next year. But you have $53,000 that you can use from your IRA to fund a charitable gift annuity. It operates under the 1 year and done scenario, meaning that you can only use this option in 1 year of your lifetime. You cannot take that 53,000 and give 33,000 in this current year and then use the remaining 20,000 next year. You can do 2 gifts sometime during 1 year and they add up to 53,000, but you can't spread that $53,000 over 2 years. It's 1 year and you're done, unless of course the law changes in the future, but that's the current scenario. A qualified charitable distribution, as I mentioned earlier, does not increase your taxable income, and it does count towards people with the required minimum distribution. And so that's a beautiful thing. There is no charitable income tax deduction associated with this kind of gift annuity because you're already getting a tax benefit. It's not increasing your taxable income, and it does count towards your RMD. So unlike most, like the table that I had in the previous chart where you have an income tax deduction, if you use an IRA, there is not an associated income tax deduction. And your annual payments are taxed as ordinary income, which frankly is much better tax-wise than if you were to take the entire IRA withdrawal yourself. And I'll show you why and what that looks like. All righty, here's an example. So you use the $53,000. Let's compare if you took the RMD yourself versus if you used your $53,000 from your IRA to fund a charitable gift annuity. So this is a 76-year-old donor in a 32% income tax bracket. The left-hand column, the donor takes the required minimum distribution, and the income, taxable income, is $53,000. And so since this donor is in the 32% income tax bracket, the tax would be 32% of that $53,000 or $16,960, all payable when you file your tax return. If, on the other hand, you take this $53,000 that you're required to take out of your IRA, maybe you're not required to take it, but if you are, it counts. You use it to fund a charitable gift annuity. Your income from the required minimum distribution, as I've said all along, is zero. There's no income, no taxable income from that because it comes straight to Skidmore and it funds your charitable gift annuity. So no income from your RMD. You will receive income payments back from the college from your charitable gift annuity, and your payments in this particular case, this is a 76-year-old donor, and they would qualify for a 7.2% charitable gift annuity. So 7.2% of the $53,000 is $3,816. So that's your income. You're going to receive that every year, and that is taxable. It's fully taxable. But your tax in year one, it's 32% of that amount, or $1,221. And so the tax bite in the next year is a lot less, and you receive an income. Of course, you don't have that $53,000 to spend as you will. Actually, you wouldn't have $53,000. You'd have $53,000 less, almost $17,000. But you'd have all that money which remains. But if you use this to fund a charitable gift annuity, you'd have that reliable income stream. So that's just an example of how you can use an IRA to fund a charitable gift annuity. Those are all fixed payment options. Let's talk about the variable payment option. It's a charitable remainder unit trust. These are ideal for highly appreciated stock long-term, again, in real estate. And we've done this with people. I've worked with a lot of people over the years on funding charitable remainder trusts. Once the asset is put into the trust, it's liquidated and sold. There's no tax associated with it. Whereas if the donor keeps the asset and sells it themselves, there's a capital gain tax. Well, that doesn't happen inside the charitable remainder unit trust. So all the proceeds can be reinvested and put to use to make payments to you, the donor. So that's a huge benefit, whereas if you did it yourself, you wouldn't have everything. Payments are a fixed percent of the trust assets as revalued annually. Well, what does that mean? That means typically every year on January 1st, we look at the value of the assets inside the trust. And if you have a 5% trust, you would get 5%. So if it's $100,000 on January 1st, you're going to get $5,000 that year. If during the year it's gone up, in the following January 1st, it's gone up to 110,000, then you would get 5% of that, or $5,500. If, on the other hand, the value of the assets in the trust drops, and we know that that's possible, it could, if it falls below 100,000, then you're not going to get 5,000. You're going to get 5% of whatever is in there. If it was 90,000, I believe it would be 4,500. So the value does vary from year to year. However, in the long run, this is actually used as an inflation hedge. And generally speaking, if you keep the rates low, the payout rate 5%, and that's the legal minimum. If we beat on average, if our investment returns on average exceed 5%, then the value of your payment will grow in time. It's not going to be a smooth curve, but in time, that value of the payment to you should increase each year. So not each year, but in time it'll grow. And so these are actually used for people that are younger. As I said, the charitable gift annuity donors, we don't pay before somebody reaches the age of 60. But a charitable unit trust donor, we can do that. So these are great. We can, if you think you might have something that might work for this, you can contact me individually, and we can look at your individual circumstances and see what this might look like for you. So that's the variable payment option. And now I just want to close and to say that whatever it is that you want to do at Skidmore, whatever interest you have, maybe you want to support a certain department, or you received a scholarship and you feel like you want to give back to support your department or a scholarship. You decide how much of an impact you want to make in that particular area. We can help you explore different ways to accomplish that goal for you. And it all depends on what you want to do. So I think that's my contact information, and I guess I can leave that out there. But I do have some questions that have been submitted, and I'm happy to go through those right now.
Art, thank you so much for that terrific overview of gift planning options to help alumni, parents, and friends of the college achieve their philanthropic goals for Skidmore. Really helpful information. Happy to share the questions that we've received. First one is, I already have a will and I don't plan on revising it for several more years. Is there anything I can do in the meantime?
Sure. Not everybody's going to run out and see your lawyer. Obviously, they charge by 15-minute increments if you visited them, and they're not cheap. But yes, there is something you can do, and it's a beneficiary designation. You can go do that with a bank account. Frankly, you go to your bank if you have bank accounts, a brokerage account, an IRA, any kind of retirement account. You get a beneficiary designation form. You can do it from the comfort of your home on your computer, and it's very easy to do that. And those assets actually don't even have to flow through your estate. So it's something that you can do yourself, very easy. And I would highly recommend that way of giving. There are definitely advantages to doing that.
Terrific. Pardon me. Second question. I own some long-term highly appreciated stock. Is it better for me to sell the stock and donate cash, or should I donate the stock?
Yeah, well, so the only time you would want to sell stock and donate cash is if the stock has gone down in value. Because if it's gone down in value, you sell it, you actually have a capital loss, and you can use that capital loss to reduce your income taxes. But if your stock has gone up in value and you've owned it more than a year, then donate that stock directly to the college, and you'll get a deduction if you itemize. And even if you don't itemize, your gift is the full fair market value of that stock. And then, hey, take your cash that you would have given and just rebuy the stock. That's definitely a winner if you like the stock. So definitely better to donate it.
Great. Great advice. Question number 3. I don't need the required minimum distributions from my IRA. They only increase my taxable income. Do you have any suggestions?
Right. So if you're donating to the college, and we hope you are, make your gifts using your IRA through a qualified charitable distribution. I mean, you can donate that way to any qualified charity. And it's just a really efficient way to give. It doesn't increase your taxable income. And as I mentioned in the example, it could possibly help you reduce Medicare Part B premiums. So that's a great way to give.
For sure. Thank you. Question number 4. I'd like to make a significant gift, but I can't because I'm retired and living on a fixed income. Plus, my stocks and other investments have been paying low dividends for years. Do you have any suggestions?
Well, sure. A life income gift, either a charitable gift annuity or a charitable remainder trust. And we can look at exactly how that looks. You have a fixed income, and if you have enough assets to take care of your health care and other living expenses, a life income gift could definitely help you. I mean, if you're not getting high dividends, and the dividends have increased and interest has increased, obviously, over the last year, but you might be able to do better with some life income gift arrangement. We can look at that for you and with you.
Terrific. Thank you. Question number 5. I don't need the RMD for my IRA this year, but I don't feel comfortable donating it to Skidmore either because I might need the money in the future. Do you have any suggestions?
Sure, we can look at using it to fund a charitable gift annuity. And so you'll receive income back from it. You'll lose the asset as far as control over it, but you will definitely create a permanent stream of income to you. So that's something that you definitely we can look at that with you.
Great, thank you. Number 6, I was going to give my vacation home to my children, but they're doing very well and really don't need it. What are my real estate giving options?
Well, I've worked with people over the years who were in this exact scenario. That was a great thing. Well, their children were younger and the grandchildren were young, but people get older and families sort of they move to the opposite ends of the country, and the vacation home doesn't get used anymore. You can put it into a charitable remainder trust. We can sell it, and then you can get an income stream back from it, or work with somebody on that, or you can just donate it outright to the college, which is a wonderful gift. Obviously, you have to have significant assets to do that. Or you can do a retained life estate where you keep that vacation home. Maybe you still want to go there, but you deed the remainder interest in the vacation home to us, and so you get a very significant income tax deduction. So those are 3 big options there for that scenario.
Great. Last question we've received so far is, my professional advisor hasn't mentioned gift planning. Is this something I should bring up?
Absolutely. Sometimes professional advisors, they might not mention that, but this is, you have to sort of be in the driver's seat. And if Skidmore or other charities are important, you tell your advisor, look, these charities are important, and I'd like to consider a charitable gift, and they can help you pick out assets that would be appropriate for that. But absolutely, keep in mind that professional advisors, and particularly in the financial world, are paid by assets under management. So some of them are very helpful, but others might not be so helpful. But yes, you absolutely should bring it up. Beth, I do actually have a few questions from people. I don't know if there's any others online, but we do have some questions that were submitted ahead of time, and I have those here. And so I just want to address those unless there's other questions that have come in.
Nothing else has come in.
Okay. So one person had said that they were thinking of making a Skidmore contingent beneficiary of their IRA after their spouse. Is it a good idea? Is it a bad idea? Is it better or worse than handling via my will? Well, certainly, I would always recommend that your spouse be your primary beneficiary, but absolutely make Skidmore a contingent beneficiary. Sometimes people do a Skidmore a beneficiary if there's a catastrophic loss in the family, and we would only receive the remaining funds if nobody was living in the family. That it's a horrible scenario, obviously, but people do that, and we appreciate that, and they certainly don't want anything bad to happen. But as far as giving through your will, an IRA does not need to be given through a will. I'm not an attorney, but I do know that an IRA, we receive IRA gifts all the time, and they're not through a will. So you can talk with your attorney about your individual circumstances, but you can go on the computer, get your IRA beneficiary designation form, and put Skidmore on there, either as a secondary or contingent beneficiary. I really can't speak to the benefits of doing it through a will. You'd have to talk to an attorney about that. I did get another question here, and it says, my trust and will now state that half of my assets will go to Skidmore, and we're really grateful for that. Is this the most tax efficient way to give this money? Maybe a retained life estate could be helpful, where you have a home or vacation home, and you can save income taxes, a lot of them, in your lifetime. And if this person is on the call right now or the session right now, I'd be happy to explore that with you as far as what it might look like. But there are significant income tax savings that are available to you potentially. But of course, it's always efficient if you have a taxable estate, and it varies from one state to another. But if your estate is taxable, giving to charity reduces your taxable estate. So that's always efficient. But there's ways to save taxes in your lifetime. And the primary way, as I said, is the retained life estate. And then I have one other question, Beth, that had come in ahead. Is there an age minimum for annuities? We want to set one up, and this paper cut off here, but for somebody who's pretty young. As I said during the presentation, we don't pay annuities before age 60. Now, will we do what's called a deferred annuity, where the payments would start at a later date? We will take a gift from somebody that's in their 50s and defer payment to age 60. But once you get into the 40s and younger, it just doesn't, the gift portion of it sort of starts disappearing. And so the age minimum at the college is 60 for a current payment gift annuity. And those are the questions that had come in ahead of time.
Terrific. Nothing else came in. So I want to thank you, Art, and thanks to each of you for participating in today's gift planning webinar. We hope you found Art's overview as helpful as you think about the impact that you'd like to make with your own gifts. We'll be sending a video recording of today's session via email, and we'll also be posting this recording on the Skidmore Gift Planning webpage, which you can find at myimpact.skidmore.edu, so you can refer back to this information. As a reminder, Art is available to answer your specific questions by phone, email, Zoom, or in person. Stay well, everybody.